Admit all. Hey, good afternoon, everyone. My name is Marissa, and I will be your host and administrator today. Welcome to the April 2024 First Friday webinar. Today's presentation is titled, What is the Market Missing? In November 2022's First Friday meeting, we discussed the fact that earnings had increased significantly since the 1980s. Growing earnings has increased stock prices at over 10% per year for the last 40 years, creating record levels of new wealth and an equal amount of hubris and memory loss. Investors forgot that the US stock market was not supposed to grow at that rate. The investing public believed the world had changed and that the future was going to be one continuous yellow brick road of prosperity. And then the great financial crisis hit. This crisis actually threatened the global financial system. It was a stark reminder to speculators all over the world that leverage increases positive outcomes and negative outcomes. It appears that the world has forgotten the lessons of history, as today our leverage is 10 times higher than it was 15 years ago. Our prepared comments during this session will be recorded, as other families who are unable to attend have asked us for the recording. Please note we will not record your questions, as privacy is always a top priority for our firm. Our prepared remarks today will be approximately 15 minutes long, with some time left over to cover questions from the participants, along with our standard topic, which is, what is the market missing? If you have already sent us your questions, we want to thank you. Your questions truly help us understand what topics are most important to each family we serve. If new questions arise from the content of today's presentation, please either send the question along by typing your question into the chat box at the bottom of your screen, or write it down and raise your hand at the end of the prepared remarks by clicking on the icon at the bottom of the screen. We will do our best to get to your question at the end of the prepared comments. One final note, please remember to mute your microphone and stay on mute unless you have a question, as background noise is audible and distracting. With that said, let me turn the presentation over to Stephen Abernathy, who will provide today's commentary.
Good afternoon, everyone. I'm Stephen Abernathy, and this is the April 2024 First Friday meeting for our family office members. And just a quick reminder that it's the 16th Monday or 16th monthly meeting, and all of the prior webinars are on our website if you'd like to go back and fact check us. It's a good process that keeps us pretty straight. So today we're going to discuss and to show you why the stock market is within 5% of an all-time high, and why the world believes we are not going into a recession, yet the current data tell us, based on history, a recession is likely. We believe that what the world has forgotten is that we've increased our debt, meaning we've increased our liabilities to wartime levels during the best of peace times, which are going to prove to be a long-lasting mistake. And this mistake is going to continue to baffle our economy until we fix it. And so far, politically, on either side, I don't have any comfort level that either side is talking about reducing the elephant in the room, which is our debt levels. We're going to show you clearly what the market is missing, or said differently, what the market is forgetting, because that's the important part here. And some of you will remember our webinar in 2022 when we went over a lot of this information. It's quite interesting. Certainly, no one knows what's going to happen once the market comes to grips with what this market is missing. Yet we'll explore what's going to happen, or what's likely to happen, when the market comes to the reality that what happened over the course of the last 25 years is unlikely to happen over the next 25 years, or in some cases, it's unable to happen over the next 25 years. So the Goldilocks conditions of the last 20 years have weakened our economy and most likely created expectations that are unreasonable, as you're going to see. As the chart shows, a significant change took place between 1990 and 2022. Profit margins increased by over 25%. Now, again, that's not impossible. In an emerging market country or one of the other developed markets that is, earlier than us, this might be possible. However, in a mature, developed country like the United States, this is quite unusual. And it begs the question, why? Could it be that capitalism finally figured out how to get more juice out of our economy? Or could it be that external events shifted and brought a magical benevolence to our corporate America? I find that hard to believe, but it's possible. We will explore this next with an eye towards the most important question. Can whatever took place to increase our operating profits by this miraculous amount over such a short period of time still be with us or reproduce itself? Let's first see what happened to our stock market as a beneficiary of higher profit margins. And let's see what happened to corporate earnings, which are the manifestation of profit margins. And you might ask, why do we want to spend so much time on this? It's because earnings largely define the value of a financial asset. And as earnings go, so do the valuations of our profits. Said differently, if financial assets, or if a financial asset's value is largely related to its earnings, that it will define its earnings over time. What this chart shows is that corporate earnings increased from a growth rate of just under 4% per year to almost 15% per year over the last 20 years. That's incredible. It's a significant increase, and it's also a reasonably abrupt increase. Now, these are just data, and we're constantly kind of scratching our head as what would have created an increase in corporate profitability, which translated into corporate earnings of this magnitude. Some would offer that the world of capitalism and innovation finally figured out how to use the internet to increase productivity, thus translating into profitability. And we believe this has, there's something there. There's some merit there. However, the internet had been part of our corporate lives for well over 20 years during this period, before this period started, and it really doesn't explain the explosion of profitability and earnings over the last 20 years or so. And as we explained in our 2022 webinar, our US economy had some tailwinds that provoked incredible growth, which most of us have forgotten, and which are incredibly unlikely to remain in our memory, but we need to review them. So let's just go over these tailwinds real quickly. Number one, here's a chart showing corporate America's increase in debt over the last 15 years. As we all remember, debt increases leverage, which means good outcomes become great and bad outcomes become disastrous. Over the last 15 years, the increased leverage was clearly a tidal wave of tailwinds, which allowed a growing economy of 2% a year to experience well over 10% a year in earnings growth. However, that's not the end of it. Corporate America had some helpers. Just this chart shows that as corporate America increased its debt, the US Federal Reserve was decreasing interest rates. While the US Federal Reserve started decreasing interest rates after its fight, you remember the fight to its death in the 1970s and 80s inflation bout, we continued this practice of lowering interest rates to levels seldomly experienced in world history. The summary of this is that as corporate America increased its debt to leverage financial performance, our country decreased interest rates, making it increasingly profitable for most companies to create more and more leverage because the cost of this leverage decreased, thus increasing profit margins and earnings as if we were on steroids. The great financial crisis hit us. It unleashed a world of bankruptcies on over 20 banks in less than 2 years, along with hundreds of thousands of individuals and corporations, all with one commonality: speculative leverage. This sent our economy into a period of repair that took us well over 10 years before we could regain our footing. You would have thought we would have learned something over that period, and we did. We learned that we could continue to issue debt, decrease the cost of the debt, and spend money as if we were creating profits, as long as the world allowed us to continue this charade or this exercise in frivolity. And that's exactly what we did. Just when you thought it couldn't get any better, there was one more benefit, which was keeping our Goldilocks economy going: corporate tax decreases. As many of you know from running your own company, there are few changes in corporate structure that create increased profit margins and bottom line earnings than tax decreases. It flows right to the bottom line. Now that we've gone through these 3 or 4 significant framework changes, all in our benefit, this short history lesson of data and its results, it's pretty easy to see why the results during the 21st century have shown increased profit margins and increased earnings at rates that are almost unbelievable. All of these have led the stock market performance to one with few historical parallels. Now, let's just fast forward to today. So what's the market missing? The reason understanding what the market is missing is so urgently important is because the missing part is not priced into the current valuations. So the market has priced in growth expectations for the next 5 to 10 years that we believe are completely unreasonable, yet they're based on our history. So this is psychologically just called recency bias, and it happens all the time. It's not unusual. The last 20 years of earnings have been aided by almost free money, and this is ending. So the first question every intelligent investor must answer is, what amount of future earnings is the current stock market pricing into today's current valuation? So in order to get to today's overvalued stock market, what are we pricing in as our future in earnings? And the next question to follow right after that is, what's the stock market able to deliver, or is the stock market able to deliver those earnings? So the stock market is pricing in growth of almost 13% in 2024, followed by an almost 15% growth in 2025. These are growth rates we experienced during the last 20 years or so. So it's not a shock. Humans have a habit of believing what happened yesterday will happen again today. Sort of Groundhog Day-ish. Unfortunately, The tailwinds, which offered us incredible investment results over the last 20 years, they've shifted. They are no longer tailwinds. Debt loads, which fostered significant earnings increases, are unlikely to be allowed to expand from current levels. So I think it's reasonable to assume that debt loads don't increase significantly, if at all, more likely to decrease. Two, interest rates are unlikely to decrease from current levels. Much more, meaning they may decrease from 5.3 to 5.5% down to 4%, but we're not going to see a 12 or 15% interest rate go down to 0%. Those years are over. And tax rates have been reduced to levels which are much more likely to be higher in the future than lower. So we believe an intelligent investor would realize that the future is difficult to predict, number one, obviously. However, the tailwinds that allowed us to put together back to back 15%-ish kind of average annual earnings increases, they're not there. And most of them have become headwinds. So, however, here's what we believe to be reasonable expectations for the future of our capital markets. Debt growth experienced over the last 20 years will not be duplicated over the next 20 years. This creates a headwind for risk assets. So again, this is our macro view. Next, interest rates over the next 20 years will not experience the downward trajectory they experienced during the last 20 years. This also creates a headwind for risk assets. And corporate tax increases or corporate tax rates are unlikely to be lower over the next 20 years relative to today. They're much more likely to be higher. This creates a definite headwind to risk assets. So we believe there's likely to be innovation which allows our economy to become more productive. This is true, and this is a tailwind, as most of you will remember from the last First Friday meeting. We discussed pretty deeply AI, and we've had conversations with many of you offline about AI and the ability to be a real product enhancer, but it's going to take time. It's going to take years, and it's going to take a lot of money up front that people will spend, and probably 50 or 60% of that money is just going to be wasted because it won't be as productive as they think. But AI will produce gains in productivity. It will also produce problems with employment or challenges with employment. I don't want to say problems, with challenges. In short, we believe it's a tailwind for risk. We believe that innovation and thoughtfulness is a tailwind for risk assets. Yet, as I said, it comes with the downside of reduced employment. So I'm just bringing this up because our economy tends to find balance, there's going to be volatility in these trends, and these volatility measures are going to be measured in decades, not days. Lastly, I want to make sure that I talk to you about geopolitical conflagrations. They're also likely to play a part of our future. And here's what keeps me up at night, as I indicated in the note to you all today. No one's pricing in any significant geopolitical event. This is absolutely crazy. It doesn't mean that they're going to happen. It just means that you can't create a probability matrix without pricing in a geopolitical event that could be life-threatening. So while we know it's wrong not to price into, price a geopolitical event into our future forecast, we're not sure how to forecast the global, potentially life-changing event. We just know it's unintelligent not to factor this into our thinking. And so the portfolios that we've built, we have already price shocked them for this. So where does this leave us? Our belief is that one of the three following outcomes will become pretty clear over the next 5 years. Number one, easy to see, we've all lived through them. The market will correct. This will bring, I guess how I could say is, it'll bring our current multiples or pricing or valuation down to the multiples of 15 times earnings, which we're somewhere in the low 20s right now. That will be a sort of a 40% to let's say 30 to 50% downturn, and that's okay. It's not pleasant, but we'll live through it. For those of us, including me, who are getting a little older, it's a little not comfortable, but that's okay. Number two, market volatility increases with no appreciation over the next 5+ years. This gives earnings time to increase and catch up with the current overvaluation priced into today's market. So that is our most likely base case. And number three, which also is sort of an equal base case here, is that market sectors have their own individual bull and bear markets or bull and bear periods, and the market goes again nowhere over that period of time again. The point of this, I think, is that we would advise each of you to make sure that you measure your risk tolerance, you understand how much you're prepared to lose during a correction. We don't think that the next correction or the next recession is going to be the last recession that we're going to have over the course of the next 10 years. We think that the debt levels that are currently, that we've currently, excuse me, embraced, they will create more frequent bearish periods or recessions. The first one we'll get through just fine. The Fed is prepared to get through the next recession by lowering interest rates and infusing money into our economy. The problem with this is that just like your neighbor who's overly indebted, you can't keep going back and revisiting the same set of activities of overspending unless you fix the underlying problem. And again, I'm not trying to harp on one single elephant in the room, but having $34 trillion in debt and having a budget deficit planned for next year of 6 or 7%, which is sort of a trillion to $1.5 trillion, with, as far as the eye can see, it is clearly unsustainable, is the nicest word I can put by it. And it has to be fixed. It's a politically untouchable topic, but it has to be fixed. There's no doubt about it. And again, I know that you guys are tired of hearing me talk about this, but it really is the elephant in the room, and it causes all kinds of domino effects in different industries, and it's just not going to end well. I hope it does. I hope we find a way to grow our way out of it, which is what Goldilocks would try to convince you is possible. I've just never seen it. And about 7 years ago, I sent each of you a book called "This Time It's Different" by Rogaine and Rogoff, and it talks about the last sort of 1,000 years of financial history that we have good records on, and it shows you that each time an economy that is a world level economy becomes indebted over 90% of its GDP, it slows the economy, sends it into several or multiple recessions, and typically forces those economies into war. That's Thucydides' curse, and it is a frightening thought. With that said, let me just stop and find out if there are questions and maybe talk about anything that you'd like to talk about. Marissa?
Yes, I do have a question. So I know that you've already addressed some questions that every intelligent investor must answer, but I have another one for you. What if we're wrong?
Yeah, sorry. Yes, that was supposed to be part of my presentation, and I forgot to put it in there. That it's convenient when every when any analyst or when every analyst forgets to end the presentation before they talk to you about what happens if they're wrong. they're just trying to sneak out of the room without answering the difficult question. So here's the case. So if we're wrong and we don't go into a recession, our portfolios currently have somewhere between 20 and 30% in a diversified global marketplace of the equity markets. And it is allocated 50% to the US, 50% to non-US. Reason for that over allocation to the rest of the world is that, as you know, the United States represents 25% of global GDP, which means the rest of the world represents 75% of global GDP. And we believe that the United States is overvalued relative to the rest of the world. And if you'd like to see a chart on that overvaluation, please either drop me a line or give me a call. I can send it to you, and I don't want to bother you with it, but it's pretty easy to understand. So on the one hand, we are significantly less weighted towards risk assets, and we're much more heavily weighted towards income producing assets. And in those income producing assets, we have natural hedges. So for instance, energy. Lots of people are negative on energy, and it's okay, but it creates a crazy time where we can capture 7 to 10% per year in dividend payments from these energy companies, and it is quite clear to me that we aren't going to, or let me say it differently, we're going to need energy for another 10 years or so. So on the other hand, if we get into a geopolitical event, energy assets become worth 2 or 3 times the amount. So it's a little bit of a natural hedge. So on the one hand, the portfolios that we put together have an equity income level of about 2 to 2.25% for 20 to 30% of the portfolio, and the rest of the portfolio is somewhere in that 5.5 to 9% range, with an average yield of about 6%. The reason I'm bringing this up is that what we've tried to put together, and what we caution each of you to kind of think about, is a portfolio that will deliver the returns that you need, regardless of what happens, because we just don't know. The uncertainty's high, and again, no one knows how to value these geopolitical events, and it is difficult, but they must be part of the valuation process. Let me just stop right there, Marissa. Maybe that didn't explain what they were asking for, or tell anything else.
No other questions. That was great. Thank you.
Great. Okay, guys. If anybody has follow-up questions, please feel free to call. We're here, and we're going to be here till around 6 this evening. Thank you for attending, and we will see you next time.